SPY and SPYI track the same market but deliver completely different outcomes. One is built for growth, the other is built for income. But here's the real question. What happens when you combine them? Today we're putting that to the test. We're breaking down SPDR S&P 500 ETF Trust, the benchmark for pure market growth, then NEOS S&P 500 High Income ETF SPYI, designed to generate consistent income using options. Same index, same starting capital, same time period, but completely different strategies. And then we combine them. Because this isn't just about picking growth or income. It's about whether blending both can improve total return, increase income consistency, and reduce volatility along the way. Because the real goal isn't just higher yield, and it's not just growth. It's building a portfolio that can pay you and grow over time. So let's get into it. Welcome back to Simply Money. So today we're going to take SPY and SPYI, SPY and SPYI, and we're going to look at them individually, and we're going to look at them combined and see how they make each other better, how they can really complement one another. We just did a video doing the same thing with SCHD and SCHG and seeing the power of growth combined with some dividend growth income. So today we're looking at a pure income play with SPYI and a growth with SPY. And we're going to see how these work together and how they work individually. So let's dive into the spreadsheet. What we do on this spreadsheet, and if you like this and would like a copy of it, this is the Simply Money Portfolio Planner. You can get a copy of it in the description below at Buy Me a Coffee. All of our spreadsheets are available there. And this one here you can do a lot of different things with, but what we're going to do with it today is we're just simply looking at SPYI and SPY. So we put the ticker symbols here. And on this, you can pick up to 10 different symbols, and I have those listed right here. And if there's something you want, if you buy this and you're like, the ticker I want's not on there, you just tell me and I'll add it. I don't have every ticker available because there's just too many. So when people request them, I'll add those on. But we're only going to look at two. We're going to look at SPYI and SPY. We have it in these three different strategies. We have the conservative, the moderate, and the aggressive. Now this is set up where you can go ahead and maneuver, like if you had 10 funds, you can put a higher percentage into something to make it more conservative, or move it and shift a higher position into something else to make it more aggressive, or somewhere in between is moderate. But what we're going to use it for today is we're simply putting 100% of SPYI in one model, 100% of SPY in another model, and then we're going to do a 50-50 in the third model. So it's not really about conservative, moderate, or aggressive. It just gives us three different scenarios that we can look at very quickly on this spreadsheet. We're going to start out with $100,000 of capital, just straight up $100,000, not adding to it, not doing anything, just what does it do, how does it grow, how does it provide income, and how does that income grow over time. And we're going to look at this at the 20-year marks, what we're going to look at it for. You can go further if you'd like. But for this video, we're just going to do 20 years. Now, on here, you can also add rules of like if I want to add monthly income or a one-time income and add to it. You have up to 10 rules that you can add if you want to build this yourself. But again, today we're just looking at comparing SPYI with SPY and then a combination of both. So we're not going to be using these deposit rules, so I don't have any set there. Then you come over here to the forecast tab, and we pick the model we want. We have the conservative, moderate, and aggressive. We're going to start with the conservative, which is the SPYI. Again, this isn't about whether it's conservative or not. It's just where I have it placed in the chart. If you look at SPYI, you can see that the first month of this, you have $100,000. It would produce about $935, give or take. And this is all based on past performance. We don't know what the future will hold. Remember that all investing comes with risk. This is not financial advice. This is just for educational and informational purposes only. As you can see, looking down at this just over the first year, you can see how that's slowly increasing because we're reinvesting. Again, this is an accumulation for 20 years. We're not running this model about using it yet. We're just seeing how it operates over an accumulation period. We can change this to where we're using it and see how it does as well. And that's where, if people like these sheets, a lot of people buy them because they can play around with different scenarios themselves with their particular funds they want to look at. But again, for this video, we're just looking at what SPYI does. So we're going to come down here to year 20, the end of year 20. Right here we have the end of year 20. We would have a balance of 1.3, almost $1.4 million. So SPYI has done really well because you're getting that income and you're reinvesting it, buying more shares. And at the end of 20 years, you'd have $1.3 million. And look at this, you're generating just under $13,000 per month. If you were to say at the end of 20 years, I'm going to turn this off, the drip, and I'm going to start using it, you'd be producing about $145,000 per year with a strict SPYI portfolio with $100,000 starting. Remember these figures, and we'll bounce back to this, but you have between $1.3 and $1.4 million portfolio balance, generating about $144,000 per year. Now, if we go back up, again, remember, if you were to put $100,000 in and start using it, you'd only be getting $900 a month because you're not going to be accumulating all this reinvestment. Your portfolio is going to look different, but we're doing accumulation. Remember that. Now, if we go over to SPY, this under the moderate tab, we put it over there. Again, you start with $100,000 and see it's producing about $88 a month. It's not an income play. There is some distribution because of dividends. Some of the companies offer dividends that are in SPY. So you do get some little bit of dribble of income, if you want to call it that, but those are being reinvested as well. If you were in SPY, you're not in it for income. You're in it for growth. So we're going to come down here again to year 20, and we want to see what it would look like if we played the pure growth factor on this. Year 20, the end of year 20, you're looking at 1.6, almost $1.7 million. Quite a significant difference in the amount that you would have if you went with the pure growth. And if you were to turn that drip off, you'd be getting about $1,400 a month. Again, nothing great there. It is some income, but nothing that you're going to live on. But you could obviously supplement your income with that. It's a nice little supplement to your income with $1,400 a month. But this is a very nice portfolio with almost $1.7 million. That is what one does versus what the other does. But what I want to look at is what happens if we were to combine that. We take this and we have 50-50. If you look over here again on the portfolio engine, 50,000 went into SPYI, 50,000 goes into SPY. Come back over to the forecast tab. We chose aggressive. That's the scenario it's under. You see your $100,000. Here you're getting about $500 a month. It's pretty nice income. And then we're going to see what the growth does. Now you got to remember, when you have the 50-50, you're getting that reinvestment of, you have the income coming in from SPYI, and it's being reinvested into the portfolio. You have that growth factor taking place, and you have the income being reinvested. We come down to year 20. You can see at the end of year 20, now we're looking at $1.5 million. So with just SPYI, you're looking at about 1.3 to 1.4 million. With SPY, you're looking at about 1.6 to 1.7 million. And with SPYI and SPY combined 50-50, you're looking at about 1.5 to 1.6. So you don't lose a lot of the upside, a lot of the growth. You don't get all of it, but you get a substantial amount, quite a bit more than if you just went with SPYI. If you look over here, your income, obviously with just SPY, you're not getting much income. What was it, about $15,000? Let's double check that here. With SPY, you're getting $16,000 of income, but with SPYI, you were getting $144,000. When you combine them, you're giving up a little bit of the growth and a little bit of the income, but to me, it's a nice combination. And I've shared this before. Like I said, we did another video with SCHD and SCHG, two that I hold, and getting that combination of both. So you're getting the income and the growth playing together. And so you're still getting a nice portfolio ending balance here. But look at this, you're still getting $90,000 a month off of this. If you were to do this, now think about it, if you went with just the growth right here, and you needed $60,000 a year, you would have to sell shares. And a lot of people are fine with that. You sell a certain number of shares each year to generate the money you need to live on. And that's where a lot of people approach retirement. Now, if you went with the conservative, okay, you don't have as much of a portfolio, but you don't need $144,000, so you can take $60,000 out and reinvest the other $80,000. Whatever the case might be. And again, everybody might be different. Maybe you need $90,000. Whatever the case is, the combination of these two, tracking the same index, you're getting a lot of that upside, so you end with a really nice portfolio balance, and you're generating $90,000 of income. If we were to do that, and you can look here and see, okay, now we're taking the income instead of reinvesting it, because we're at the end of 20 years, say we're retiring, now we're taking out $8,000 a month, and you're still getting slight increases. You're still getting growth because you have the SPY pulling the growth element. You have the SPYI generating income, and that income is going up slightly each and every month. You can see how the combination gives you a nice balance between growth and income. And I think a lot of these funds, like we'll do another video here with QQQ and QQQI, combining them versus separate. I think they can really be nice supplements with each other. I know what some people will do is they'll buy the income instead of reinvesting just in the income, they'll reinvest into the growth index. So let's say we put 100% into SPYI, but then all the income that comes in, instead of buying more SPYI, we buy more SPY. We just put that income into that and build the position, dollar cost averaging month over month with the income. And there's different ways people can approach it. You're going to have to make a decision what works best for you. But you can do that on here. You can set all these different rules, different funds you want to look at, different positions and percentage in each one. You can, if you want to say, okay, I'm going to add monthly $200 a month, and we're going to do that for 20 years. What's that, 240 months? We can do that. If we come over, we got to go to the Forecast Pro to see that. We're going to split it equally, 50-50. Come over to Forecast Pro, you can see you start with the 50-50 on the amount you started with. Income generated is right here. Deposit is right here, so you put 100 in fund 1, 100 in fund 2. So there's different ways that you can look at this and get a feel of how that's going to work for you. Those rules are really powerful, and you can do one time. If you get a bonus, if you get an inheritance, you sell a house and have equity, you can set up all those different rules and see how you want to use that and going forward with those. That is how this works in this spreadsheet. That's why SPY and SPYI are really powerful. The same market, different outcomes. Strategy matters more than the ETF, in my opinion. And this is what you need to understand as you look at these. It may not be all this or all that. Diversification, different methods. Income is important. Growth is important. But can you combine them and get the best of both worlds? I think you can if you look at it correctly and you find funds that you are comfortable with. So that is our video today. This is Simply Money. Don't forget to hit that like and subscribe button. I appreciate you joining me, and we'll see you next time.